Hi guys, welcome to the technical analysis section of the course where we're going to be covering technical analysis techniques in the foreign exchange market. So let's just get straight into it. So technical analysis, guys. Technical analysis is just the study of historical price movements in order to predict potential oncoming movement. And now the reason why technical analysis traders use technical analysis is because a principle is that history tends to repeat itself. Now, it also helps traders visualize historical data. Technical analysis uses charts, which gives them a full representation and a visual representation or price data over a set time frame. The time scale can vary from seconds to decades, for example. For example, an hourly chart can divide the data according to each hour, while a 15-minute chart will divide it according to 15-minute intervals. Each time frame provides important information. Now, different types of charts exist, like the line chart, the bar chart, the pointer figure chart, but the most favorite one and the most common one you'll probably see is the candlestick chart, guys, because it's easy just to determine the information and find patterns within a candlestick chart. So guys, the concepts of support, resistance, and trend levels are the essence of technical analysis. Remember, guys, that support and resistance levels are areas, they're not exact numbers. What is a support, guys? A support level is just an area where the price has shown a historical tendency to stop falling further and instead bounce back. So as you can see on this diagram here, the support level is at the bottom. Every time the price hits that support level, the price bounces back. So in other words, a support is formed of a commonly called what we call historical lows, which means the price reached several times after downward movements followed by a change in direction. Now, a resistance level, guys. A resistance level is just an area where the price has shown historical tendency to stop rising and instead bounce back. As you can see from the diagram, guys, every time the price hits that resistance level, it usually reverses. The price and the markets normally reverse in the trend. So in other words, guys, a resistance is formed of commonly called historical highs, which basically means the price reached several times after upward movements followed by a change in direction, guys. So eventually, guys, the price may break through support or resistance levels. Once a breakout occurs, a resistance level can become a support level. So obviously, as you can see in this case, the breakout has occurred and it's broken the resistance level. Now the resistance has turned into the support level. So guys, we've treated the support and resistance levels as horizontal areas, but the concept also applies to non-historical price movement. So what we're going to be talking about is the trend. Now, a trend is just the general direction of the market. Now, currency prices tend to move within what we call a channel formed by a support level and a resistance level. The extension of it into the future of the lines formed by support and resistance levels can give you an idea of where the currency price is likely to go. Now, guys, it's not guaranteed, but it increases the odds of you analyzing which way the markets will go. So as you can see here, an uptrend. An uptrend is formed by a series of what we call higher highs, higher lows. So as you can see here, guys, we have an uptrend. Now, an uptrend is just formed by a series of higher highs and higher lows. Now, you may hear a lot of traders say, oh, there's a higher high and higher low. Let me just break it down for you right now. It's not complicated at all. As you can see, whether it says the first higher high, all it means is that it has a higher high point than the last high point, if you understand what that means. So if we look at the second higher high, it's just called a higher high because it's higher than the previous high. Simple as that. And again, higher low. As you can see, the first higher low was higher than the previous low. And again, the next higher low was higher than the previous higher low. That's the principle of it, guys. It's not complicated. So that's what an uptrend is. An uptrend is formed by a series of higher highs and higher lows. However, a downtrend is just the opposite. The downtrend is just formed by a series of lower highs and lower lows. So as you can see, the first lower high. Why is it called a lower high? Because it's lower than the previous high. And again, lower low. Why is it called a lower low? Because it's lower than the previous lower low. That's all it is, guys. So when a currency price hits a support level, guys, the price is usually seen as relatively low and cheap enough and a good time to buy. As you can see, at the higher lows would be a good time to buy. But when the currency pair hits a resistance level, the currency is seen as to be too expensive and it's usually a good time to sell it. And one way to identify and draw a trend channel is by first looking at significant lows and highs in your chart. So let me show you an example of an identification of a downtrend. What we do is spot the first 3 highest points and the first 3 lowest points, and as they're identified, we join a line joining all the highs together and joining all the lows together. And by extending the lines to the right, i.e. to the future, we can see potential areas of resistance and potential areas of support, which can be anticipated. That's the whole point of trading, guys, is to anticipate where the market will go next in order for you guys to profit. Now, from time to time, a false breakout will happen. The price will trade through the resistance or support levels for a short time before returning into the trend channel. So as you can see, it has happened here. And as you can see, guys, in the 4th lower high, in that blue area, it was a false breakout. It broke out of the channel, but then as you can see, I don't even need to explain it. You can see it visually with your eyes, guys, how much momentum and selling momentum occurred once it broke that trend channel and it returned to the trend channel. So guys, to determine if a breakout is significant or not, you can compare different time frames, like an hourly one to a smaller one, like a 15-minute chart. So if the breakout on the hourly chart is minor and is minor on the 15-minute chart as well, the break can be considered as a false breakout. So in our example, guys, a good strategy would be to sell the blue area where the price reaches the resistance of the downtrend. It would be much more efficient and less risky than to buy the support in a downtrend. Indeed, if you take a look at the next lows, so if you look at the next lows on the chart, a buy could have quickly turned against you. As you can see in the 5th lower low, if you bought at that support level there, you would have lost a lot of money, guys, because as you can see, it broke that support level with ease. And that's why we don't really advise buying the support levels in a downtrend. That's why, guys, we don't advise buying in a downtrend, only because it's a lot less risky. And as you can see, the markets can quickly turn against you as the price really didn't get high before going down again. Simply what we do is just follow the general trend, and in this case we're following the downtrend. So guys, we've seen that a trend can be up or down, but the market can actually move sideways. About a third of the time, the market will move in a way that is called a trading range. Now in this case, the supply and demand are in relative balance. Most technical tools and trend following tools are not designed to work in a ranging environment. Every trader should therefore be aware of the environment he or she is trading in, guys. In a trending environment, the volume should increase in the direction of the trend. It is an important factor in confirming price signals. In an uptrend, guys, a volume would increase as price moves higher and decreases as price falls. In a downtrend, guys, the volume increases as price drops and decreases as price rises. The volume must confirm the trend.